Hello, this video is an additional note about an additional earnings metric that many financial statement users use to analyze company earnings, and that is EBITDA. So EBITDA stands for earnings before interest, taxes, depreciation, and amortization. And mechanically, this is constructed as net income and adding back these expenses. So taking interest expense and adding it back to net income, taking tax expense and adding it back to net income, and adding back depreciation and amortization. The rationale behind this metric is to try and construct a continuing income from operations number that excludes the effects of capital structure decisions, i.e. interest expense, tax considerations like state and local and federal income taxes, and any non-cash expenses like depreciation and amortization. It's important to remember that EBITDA is not GAAP. Firms often present it, firms often discuss it, but because this metric is not a GAAP-sanctioned metric, SEC rules require firms to provide a reconciliation to net income and to show exactly the adjustments that the firm made to arrive at EBITDA from net income. Firms often present EBITDA, though, under the argument that Wall Street and capital markets, including analysts, are asking us for this metric, and so we are just giving the people what they want. One other common argument is that EBITDA better reflects the underlying economics of the firm. And whether or not this is reality, though, depends on what's happening. So you want to be careful with EBITDA because of how that depends, of how its usefulness depends on the context in which it's being created. So you'll hear EBITDA talked about everywhere. You'll hear equity research analysts talk about it. You'll hear CNBC anchors talk about it. Various bankers and consultants discuss it. And you'll also hear references to it from company management in various settings like earnings announcements or earnings calls or investor days. So one thing to think about is what are the incentives of these individuals to tell you to focus on this number instead of looking at net income? So EBITDA itself is quite controversial. There are investors out there who feel very strongly that EBITDA does a very poor job at reflecting company economics. And this argument mainly focuses around the exclusions. As Charlie Munger from Berkshire Hathaway mentions, he notes that EBITDA is ridiculous because it excludes expenses that firms actually incur. So interest expense is a very real expense, and typically firms have to pay cash for interest expense. So by excluding interest expense, you're not looking at a full picture of what the firm is required to spend money on to keep the operation going. Charlie Munger would argue that taxes are real. Firms have to pay taxes. There's no way around that. So you should reflect those expenses when you're analyzing a business. And furthermore, he would argue that depreciation and amortization are a way of allocating capital expenditures over the life cycle of those expected benefits that we're going to receive from these capital expenditures. And because capital expenditures are not directly factored into net income because we follow accrual basis accounting, by excluding depreciation and amortization, which is the mechanism for accrual basis accounting to allocate capital expenditures across their useful life, we in essence completely ignore capital expenditures and long-term assets that are often used to create value for the firm. So if we're excluding a big piece of investments that firms have to make to generate their income, then we're not really getting a full economic picture of how the firm operates, would be the argument. So in addition to EBITDA, there's this growing interest in an additional measure that takes EBITDA and adds back additional adjustments. And this metric is often known as adjusted EBITDA. And the idea here is we'll take EBITDA as our starting point, and let's add back even more expenses and adjust for more items. The idea is we want to strip out additional things beyond interest, taxes, depreciation, and amortization for a wide variety of reasons. Maybe the firm took a one-time charge on a specific event that happened and that is unlikely to happen again in the future. Sometimes, though, firms take this a little too far, and so people jokingly refer to adjusted EBITDA as earnings before everything. So if we take EBITDA and we adjust for all sorts of other expenses, then the joke goes that we really don't know what we're actually even including in EBITDA. So one example of how adjusted EBITDA and EBITDA plays out is WeWork. So WeWork is a office space company where you can rent office space by the day or by the week or by the month, right? And so another way to think about it would be they are a co-working space for people to go and use office space. So in 2019, WeWork filed for an IPO. And so as part of this IPO filing process, they had to publish and disseminate an S1. The S1 filing details all sorts of financial statements about the firm for a period of 3 years before the firm IPOs. So this way, investors can evaluate the financial performance of the firm and determine if they would like to participate in the IPO or not. However, WeWork's IPO filing had a lot of extremely controversial items in there. And because of all of these controversies, in September 2019, WeWork wound up having to delay their IPO. These controversies, though, kept building. And so more information came out about how the firm was run, how the CEO was operating the business. And in October 2019, Adam Neumann, the CEO and also founder of WeWork, was asked to step down from SoftBank. So he was, in essence, terminated from his role as CEO as a result of some of the things that came out in the S1 filing as the firm was preparing for an IPO. And then shortly after Adam Neumann stepped down, the firm had to undertake a pretty severe restructuring and lay off 2,400 employees across its network. So the firm had to regroup after this IPO that didn't work out. And they did eventually go public, but it was many years later, and the firm had made substantial adjustments to its operations and to its financial reporting in preparation for its actual IPO several years later. So in the S1 that WeWork filed, here on the screen, we are looking at the GAAP financial statements of the firm. So we see here that WeWork lost money for the 3 years preceding the IPO. And this is not totally uncommon. Oftentimes, high growth firms will report losses on a GAAP basis as they're investing in their future. So here we see that WeWork recorded about $400 million of losses in 2016, about $900 million of losses in 2017, and just under $2 billion of losses in 2018. However, in the S1 filing that WeWork published, WeWork noted that they like to focus on this additional financial metric called community adjusted EBITDA. And what this metric does is this is adjusted EBITDA, further adjusted to strip out a lot of revenues and expenses items that WeWork believes do not reflect the full run rate operational performance of specific locations. And their premise is that we need to look at the run rate operating economics of each location to get a good view of how the economics of WeWork work. And if we want to do that, we would need to adjust for all sorts of expenses and revenues related to setting up the location, related to building the space out, etc. So this community adjusted EBITDA takes EBITDA and also excludes some additional company-wide expenditures. So it excludes some marketing expense. And so WeWork argues that marketing expenses are brand building, buzz building, trying to build up and launch a new location. And that once the location is running, you wouldn't need as much run rate marketing. So we should exclude marketing expenses from our assessment of the economics of each location. WeWork also argued that we should exclude most general and administrative costs, including executive salaries, because these expenses could not be directly allocated to any one specific WeWork location. So if we want to understand the core underlying economic profitability of a specific location, then we, of course, need to exclude all of the executive salaries and other related administrative costs. It's important to note that at this time, Adam Neumann was also heavily using private jet travel to travel between different WeWork locations and to meet with different team members. And WeWork argued that all of these general and administrative costs related to the executives should be excluded from assessing WeWork's underlying economics. Community adjusted EBITDA also excludes development and design costs of each location. So when you open a new location, you have to think about how should we design the space? What kind of furniture should we have? What kind of artwork should we have? And you have to go get this furniture. So WeWork would say, these are one-time expenses. These need to be excluded from our assessment of the run rate operating performance of each location. So we should throw out all of these one-time upfront furniture costs, etc. WeWork does note that community adjusted EBITDA includes revenue from tenants, rent for the location, if they have location-specific staff dedicated to a particular facility, that is included, any facility management fees that WeWork has to pay, etc. So pretty much revenues and expenses that can be directly tied to individual locations. So one thing to think about is, why did WeWork spend so much time and energy focusing and emphasizing this particular metric in the investment community? Why do they spend so much of their S1 filing talking about these items? So let's take a look at the walk. So under US GAAP, if you present a non-GAAP metric like EBITDA or adjusted EBITDA, you also need to present a reconciliation to net income so investors can understand what was added back and what was subtracted. So here we have the net losses that we saw in the GAAP financial statements from earlier. And to get to adjusted EBITDA, they're going to add back a series of items: taxes, interest, depreciation, some adjustment for straight lining rent, some stock-based compensation, etc. And so this takes us to an adjusted EBITDA number. We'll see that here that WeWork still loses money, but they lose a lot less, right? Once we've made all of these adjustments for items that WeWork feel should be excluded from its financials, we'll see that the losses are lower. So they're between 94 million in 2016 and 660 million in 2018. Then when we look at community adjusted EBITDA, this is where we get into the pieces where items are excluded because they can't be allocated to a specific location. So certain marketing expenses, certain new market development expenses, and certain general and administrative expenses, including executive salaries, all get excluded. And we'll notice that once we take into account these additional exclusions on a community adjusted basis, WeWork is suddenly quite profitable. So if we focus on this community adjusted EBITDA number, it would look like WeWork made 95 million in 16, 200 million in 2017, and 467 million in 2018. In other words, it looks like if we focus on community adjusted EBITDA, that the economics are getting better and income is getting better on almost a hockey stick growth type metric. So it would look like this company is growing its profitability over time if we focused on community adjusted EBITDA. It's important to note that community adjusted EBITDA shows this exponential growth in earnings, but on a GAAP basis, GAAP actually would suggest that their losses are increasingly getting greater with time. So the community adjusted EBITDA number paints a very different picture of WeWork than what their US GAAP numbers would represent. So what are the broad takeaways here from this example and this short aside? The broad takeaway here is people will throw around EBITDA and adjusted EBITDA like it's a consistent and main metric that people focus on. But the reality is firms have substantial discretion in deciding what adjustments to make, so it is not very consistent. It's not consistent at all across firms. So you have to be very careful in understanding exactly what adjustments firms made to arrive at their EBITDA or adjusted EBITDA numbers. And the good news is the SEC will often have firms prepare this reconciliation from net income to adjusted EBITDA or EBITDA. So you can go and look at the back of an earnings announcement or the back of a press release and see this reconciliation table. You might also want to think about people's incentives to draw your attention away from GAAP net income towards these non-GAAP measures like adjusted EBITDA and EBITDA. And given these incentives, you might want to be cautious in relying heavily on this metric. You want to make sure you fully understand all of the adjustments that management has made, the rationale for these adjustments, and you might need to think about whether you agree with management or not in making these adjustments. So here we see that adjusted EBITDA and EBITDA are often inclusive of adjustments that try to make the firm look more positive to to investors. So just something to think about here when you think about the relationship between adjusted EBITDA and net income. And that is going to conclude this short overview of EBITDA and adjusted EBITDA as additional earnings metrics. I hope you enjoyed the video, and I hope this helps with your investing and your understanding of financial statement analysis.